right, let's get to the markets. Fascinated by some of these comments and picks. We got Oakmark Funds portfolio manager Bill Nygren joins us now with his read on the value on the market and maybe some value picks for your portfolio. And the first one I saw, Bill, and then we'll talk about some other stuff, but was Charter. I mean, it's gotten a lot more reasonable in terms of value.
It certainly has.
Are you just now deciding you like it, or?
We've owned the stock for a long time. Fortunately, we own fewer shares now than we did a couple years ago when the stock was much higher. But we think it's becoming very interesting as the business is almost entirely an internet and mobile telephone business today. And the stock's down at about 5 times earnings now.
Is that right?
Market, it knows that there's not going to be a ton of organic growth. And I think what the market doesn't pay for as much as it should is the growth that can come from share repurchase. And this is a company that can put most of its earnings into buying back stock. And that's a theme throughout our portfolio. These companies that have very low multiples and not a lot of organic growth use share repurchase to achieve per share growth rates that are in line with companies that are much more expensive.
And in your view, because the S&P is so concentrated with some technology names, you don't even think it's a sort of an average risk index anymore. You think it's kind of a high risk index?
Absolutely.
The S&P 500.
The S&P 500. I think if you went back 10 years ago, the S&P 500 was much less volatile than an average mutual fund. And people who wanted one-stop shopping could just go and buy the S&P 500. But today, the largest position in the S&P, NVIDIA, is about 8% of the index. The top 5 names are over 30%. Technology weighting, also over 30%, would be over 40 if they hadn't moved some of the fintech and communication technology companies out. It reminds me, Joe, of a mutual fund that I think you'll remember, like Janus 20, early in my career, was kind of like the primary growth fund that people looked at.
Magellan.
That one as well.
Yeah.
But I think the risk level in the S&P 500 today is much more akin to those growth funds than it is an average fund.
And it's 23 times.
23 times earnings.
But the average stock is 17. So you're trying to find the average stocks, or
well, we're trying to find things that are a lot cheaper than the average
exactly.
stock. Okay. And S&P at 23 times earnings. The Oakmark portfolio, almost half our holdings are less than half of that level, less than 12 times earnings. And I think the point that we would make is for the investor who's put most of their equity assets in the S&P 500, a nice risk reducer would be to own a value fund along with that. Of course, we would love that to be Oakmark fund, but any value fund is going to help reduce the risk of the investor's portfolio. And reduced risk products today are some of the hottest products in the mutual fund industry. And yet this easy step of combining a value fund with the S&P 500 is something that hasn't really become popular yet.
That's reasonable. We like to do things in 5s. We really don't feel like we can educate people enough if we don't do 5 things,
okay.
5 things to watch. You've got 5 picks. All right, so let's do Charter, General Motors. That's a value. But some of your stocks are less than half the normal multiple, right?
Well, the 5 that are
all less than half
the screen are less than a third.
Less than a third of the market multiple. Corebridge, General Motors, Global Payments. I guess they brought them up. Yeah, and Ally Financial.
7 times or less on next year's expected earnings.
Okay.
And as I said earlier, these companies don't have great organic growth opportunities, but they're generating a lot of free cash flow that doesn't need to be reinvested in the business.
Buybacks.
And they do buybacks and dividends, and because of that, their dividends and per share growth rates are actually in line with companies that are 3 times as expensive.
Interesting. So GM, you immediately think, extraneous factors are going to buffet that.
Sure, and tariff risks have kind of upset this year.
Yeah.
The company was supposed to earn something like $10 a share this year. It'll probably take a year or 2 to get back to that level. But at 5 times earnings, we think you're getting paid an awful lot to take on that risk. And 2 years ago, they took out more than 20% of their shares in 1 year. Mm-hmm. In a down year this year, they're still buying back about 10% of the share base.
Yeah. All right, Bill Nygren, and you must be getting good at this by now. As we always point out, Mark Haynes had to interrupt you after the first plane hit. You were our guest that day. That's 24 years.
I know. Time flies.
Right. I mention that every time, but not everyone knows. Not everyone is always watching, and it's I'll never forget, obviously.
Nor will I.
Right. And Welch never did come on. That he had a book out. He was due up after you, I think. But history came into play that day. Thank you.
Thanks for having me.